Thank you, Chair, and thank you, gentlemen, for your years of labor in this. I want to go to something at the very base of this. Having personal experience in this over the last 30 years, I've been concerned all along that the efficacy of the instrument that we're talking about here, and that's let's talk about the home mortgage. Mr. Calhoun, you mentioned something earlier I agree 100% with that was lost in the debate. This was not just a subprime issue. But what we did is when trying to encourage more home ownership in this country starting in the late 90s, we created low-income verification loans, no-doc loans, and so forth. And what this did, it didn't just entice subprime lenders or borrowers to get into a market over their head, but there were prime borrowers that overreached because if you don't have to decide how you're going to pay for it, it's awfully easy to get qualified. And so I'd like to talk about what fintech and the technology community is doing today regarding the underwriting of both of these. And I think there's a company called TransUnion. It's a big credit bureau, and they've done a lot of studies on this. I think the MBA has worked with them, and I applaud the MBA for all the work you're doing and giving us ideas about how to restructure this to learn from what we've seen, but also to adapt to the technology changes we're seeing today, particularly in this underwriting area. Today, traditional, trended, and alternative data, those are three different types of data, are being used, and according to this study, some 26 million borrowers today could possibly be underwritten today using that could not be under traditional means. And that would basically mean that 95% of the borrowing public of America could somehow be evaluated. Doesn't mean they'd all be qualified, but at least we'd have a good predictor. Isn't the way forward what companies like SoFi and Cabbage, some of these fintech communities are doing right now with regard to alternative and trended data in addition to the normal traditional data? And I'm not talking about a mortgage package that's a foot deep like we see in some institutions. But what I'd like you to do, Mr. Calhoun, is address that, because access to small markets, to the millennial minorities and all that might not have a, what they call a thick file application, isn't that what they call it? That might have a thin file. All of us had thin file applications at one point in our life. So how do we address the capabilities that that technology has given us to create more opportunities for access, not just in small markets, but in demographic markets that need our help as well? Would you address that?
Certainly, again, before my present role, I headed lending programs for more than a decade at our credit unions, including our home loan, both retail and secondary market. We support use of both the alternative data and the trended data. The alternative is, for example, traditional credit scores don't pick up rent payments. We often find, again, a good measure of someone's ability and willingness to make a mortgage payment is if they paid their rent consistently and what level of rent they were carrying for an extended period. And I know that FHFA, Ed, started the process there, and they are looking at alternative scores there. And trended, as you know, is just looking at how someone's credit score is moving. Are they improving their credit score or going down either way, rather than just a static snapshot? And I think there's a lot of potential there, too, that more accurately captures.
Could we do that without having the foot-thick, application file for underwriting? Is that still possible?
I think fintech is adding a lot of advances in that area. There are massive amounts of data, as everybody knows.
But we want a predictor. That's what you want. You want an accurate forecast of somebody's ability to repay the loan and not get underwater. Dr. DeMarco, would you just address real quick, and this is, I'm going to run out of time on this question. I'd love for you and Mr. Stevens to have a shot at this one. Access to capital is a huge issue in this market. That's what we're all trying to do. With the Fed right now having a $4.5 trillion balance sheet, with current statements saying that the Fed is going to rework that balance sheet down to the tune of somewhere around $2 trillion over the next 2.5 to 3 years, what impact is that going to have on the capital markets while we're talking about restructuring the GSEs? Dr. DeMarco?
I think the Fed is certainly anticipating doing this in a measured way in which it should have little, if any, effect on capital markets as it affects the mortgages. And I certainly would expect and anticipate that's how they plan to handle it.
I mean, the one thing we do look at, and I think it's an important question, there's a bit of an unknown. If you look over the last 20 years, prior to conservatorship, the biggest buyers of agency mortgage-backed securities were the GSEs themselves. In post-conservatorship, it was the Federal Reserve buying most of the mortgage-backed securities. So we do need to make sure that the international, the global markets view the MBS produced out of this country as a credible, good faith instrument. And that's actually one of the reasons why we think converting to an explicit guarantee on the mortgage-backed security will eliminate this question, is it really AAA backed in good faith by the U.S. government, or is it implicit? And if we can, through reform, get to an explicit guarantee on the MBS only, that will bring in a lot more institutional buyers from around the globe who today, many won't buy Freddie and Fannie MBS, they'll buy Ginnie Mae's because that does have that explicit guarantee. And that's one way to help smooth out this transition process.
Thank you, gentlemen.